Good morning, ladies and gentlemen, and welcome to the Real Estate Investors PLC investor presentation for the final results for the year ended 31st of December 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paul Bassey, CEO of Real Estate Investors PLC. Paul, good morning.
Morning. Hang on, I'm just clicking the submit document as well. Okay. So, shall I kick off, Paul?
That'll be great. Thank you, Paul.
Okay. Right. Well, morning, everybody. Thank you for joining us. This is a platform we've not used before, so bear with us if we sound a little rusty with it. I've got Anna Durnford, who's Investor Relations, on the platform. She'll be helping me turn pages, etc. And before we start turning pages, I thought I'd give people a little bit of an introduction, because while some of you will know us, some of you won't know us at all. Just going back to the beginning, REI was formed back in 2004. We were not involved at that stage. It was based in Rickmansworth, and it had a few little retail shops around the UK. Back in 2006, we were looking around for some value in the marketplace. The property market was pretty full, and we came across a little REI based in Rickmansworth. It had a market cap of 2.5 million, and it was kind of going nowhere at the time. We put some capital into it, took a couple of seats on the board, and really what we wanted was a platform to raise some funds to do what we've been doing privately since 1983, in a public vehicle, so we could fast track what we're doing, and we were anticipating markets falling off. Now, we certainly hadn't anticipated the financial crisis, but we did feel that back in 2006 prices were pretty full. So we raised some funds in 2007. We've grown what was a £20 million portfolio at the time to over £200 million. We, as a management team, have invested 10 million of our own cash into the business, converting to a real estate investment trust back in January 2015. And since then, we paid out £36 million in dividends to investors. As I said, we've been in this business for over 4 decades. A lot of experience of seeing various downturns, the real recession back in the 1990s, the financial crisis that most of us saw, and the very easy last 10 years we've had of Brexit, European referendum, Scottish referendum, the elections, and if that all wasn't enough, they threw in a little bit of COVID for us as well. So a very, very quick overview of the year, and then I'll start turning the slides in a bit more detail. It's fair to say that it was a year like no other. Things that you simply took almost for granted running our business, i.e. rent collection and tenants paying, even tenants that were significant covenants. A lot of this had to be revisited because clearly people were not trading. And the experience of previous recessions taught us that we needed to speak to people, communicate with people, and help everybody get through this, because A, it was good business for the business, but it's also the right thing to do. Priority number one, ahead of rent collection, was everybody's health and well-being at the company, which we dealt with. We spoke to people early, got our rent organised, and we've done fairly well, and again we'll come on to rent collection. Dividend, as I say, we've got a £10 million investment in the business ourselves, so we think like our investors, like our shareholders, and unlike some companies, we didn't decide to just, halt paying dividends. We understand shareholders want the return, want a dividend, So we revised what we paid. We paid 0.5p a quarter, and then we paid, or announced, and we're going to pay this month, 1.50p for the final quarter, resulting in a 3p dividend for the year. Despite all the challenges with rent collection, because of the asset management nature of various windfalls we pick up, our revenues stayed fairly strong, allowing us actually to achieve fairly strong underlying profitability. We had a number of active asset management initiatives. In a normal world, those initiatives combat any downward pressure on valuations. Clearly, we weren't in a normal world. We were in an extreme world, and whilst that's been helpful, and I'll come on to valuations, we've not been immune to valuation reductions, as has most of the property industry experience. The Q4 lockdown was really when we started to see valuations move materially. Up until then, we weren't really seeing any signs of that. And there hasn't really been any comparable evidence for valuers to measure where the valuation market is, but it's fair to say they had plenty of reason to revisit them. It didn't surprise us. Market sentiment, all the news flow, lockdown, etc., uncertainty around vaccinations, it wasn't a surprise at all. We believe we've got a diversified portfolio, and by that we don't have too big a reliance on a particular asset or a tenant. We try to keep our largest income stream to sub 5%, although the only one that we've got that's north of that is actually government income. We do believe that the region here was doing very well pre-COVID, and again I'll talk about it in a little while, but we're expecting it to bounce back pretty quickly. And if you ever wanted to be lucky, now is the time, because we've got the good fortune of the City of Culture for Coventry going on, the Commonwealth Games next year, and of course HS2 that's been confirmed. And actually this week Goldman Sachs have announced that they're opening an office in Birmingham, which I have to say was a bit of a surprise to me. As I say, we've been tested in other downturns, 2008, elections, Brexit, so we were well positioned to deal with where we are. So on that note, that's the kind of overview and a bit of a background to it. Anna, if we can just turn to the first slide. So as you can see from there, everybody, we are a REIT. We're the UK's only Midlands-focused REIT. And by that, we tend to treat Junction 1 of the M5 as our centre point. And if we can drive in any direction for about an hour, that's our patch. And I'll explain why we decided on that in a moment. Gross property assets, even after allowing for the valuation decline, are north of £200 million. We're internally managed, so we don't just gather assets with the hope to incurring a management fee for management. We buy assets because we believe they're in the best interest of the company and the shareholders. The team, which are listed later on in this presentation, are all Midlands-based, lots of experience between us. The board, again, I'll talk about the board in a moment. Again, experienced, committed, with over £10 million invested. The portfolio is diversified, as I've mentioned, 262 tenants, 53 assets. We have been caught in the headwind of retail. It is what it is, but we don't own and never have owned any department stores. We don't own any House of Fraser, any Toys R Us, any Mothercare. Of all of the Arcadia issues that are up and down every high street, we've got one shop on Kingsheath High Street next door to a Greggs, £30,000 per annum rent. That's the only hit we've taken on Arcadia. And in fact, that shop is presently under offer to two convenience operators, again, demonstrating that our retail is truly convenience. The other thing we've shied away from significantly is high street fashion. It's not what we like. We don't like the private equity ownership of those businesses. We are not a passive landlord, i.e. we don't just buy buildings, collect a bill of rent, buy them off 5.5%, 6%, share the rent over the years and wake up with possibly a significantly undervalued asset because the lease term has been declining. We like to buy things that are half empty. We like to buy things with short leases because that's how we add value. And that's not going to change. If our portfolio is ever 100% full, that kind of suggests we've not been doing the job properly because we're buying things that are too dry where we can't value add. So we are a value add business. Within our sort of shops and office portfolio, through the benefit of permitted development, we've got about 250,000 square foot of properties that we believe we would get permitted development for. And generally these are offices. Now, we can only do that if all our tenants leave. And fortunately or unfortunately, tenants have actually been renewing, so we've never actually converted anything to residential at this stage. But that's fine because residential values in Birmingham have improved over the last few years from sort of £250, £300 a square foot to sort of £400 and £500 a square foot. The outer circles where we've got other offices, valuations there are still sub 300, so they don't really make permitted development attractive enough yet when you allow for conversion costs. But we do believe that as Birmingham grows and becomes more established, those surrounding area property valuations will rise to closer to the Birmingham valuations, and the Birmingham and Prime Edgbaston and prime areas will grow from where they are at the moment. We acquire what I call institutional orphans most of the time, or distressed assets, and our target yields are 8 to 20%, and our lot size is 2 to 20 million. I'll talk about how we house them in terms of buying them, the bit we do, and what we do in terms of holding or exiting in a moment. I talked about being diversified. We treat our banking as something we should also be diversified about. So we're multi-bank by choice. I don't like the idea of being beholden to one bank. As I said, we've been in this business nearly 40 years. I've seen what's happened to people in the business over the years that were exposed to one bank. We are, at the moment, geared a little higher than I would like us. Our goal is to be 40% or less. Clearly, that will correct itself as we see some valuation recovery, which I anticipate we will. We are totally covenant compliant across all of our banks. We've got a strong market reputation amongst the banks. We were 86% fixed at the year end. One of our facilities expired early this year, which we've since renewed. That's meant that we've moved to 46% in terms of our fix. We are looking at even fixing some of that. We won't fix all of that £51 million that we renewed, probably about 35, because there's some sales that we'll be making, so we don't want sort of breakage and penalty costs in place there. We have continued to pay a dividend. Obviously, when we were doing this presentation a couple of weeks back, the share price was a bit softer than where we are now. It's recovered a touch. We're giving a fairly healthy dividend. We only pay a fully covered dividend. I expect us to continue to pay quarterly dividends. The amount of dividend that we pay is yet to be decided, but again, I anticipate something that will be similar to the pattern that we had last year. Moving, Anna, to the next slide. I said I'd talk about the board in so much as John Crabtree, who's been chairman for quite a while. We've announced that John will be stepping down. He's been first class for us, but he's also chairman of the Commonwealth Games, so he's fairly busy, but also it was the right time, so he's going to be stepping down. Will Wyatt, who you can see is the CEO of Caledonia Investments, will be stepping up to be the new chairman. And we've got a couple of names in a file and CVs that we're looking at to appoint the replacement onto the board as an independent. The one thing I try and point out to people from this slide is that unless you're from this part of the world, you won't have heard of a company or two that's on my sort of little commentary and the FD's commentary. So companies like Bondwolf and CP Bigwood are quite successful independent property management and agency businesses. They're not owned by REI. It's where I started life back in 1983. Obviously, I left that some 15 years ago, and we've got management running those businesses. We sold the management book off back in 2015. At that point, we were managing over 5 billion of property. We are also the largest auction house outside London, and as I say, one of the most active independent agencies here. I'm only sharing that information with you because I do genuinely believe that the biggest asset that we have isn't our access to money or our personal experience. It's really the market intelligence that we get from these businesses. So we know when occupiers are looking for outlets. We know when people want to downsize. I can tell you how many boards a month we order, how many sold signs go up, how many let signs go up, and all of this gives us a pattern. And it's that pattern that gives us the confidence to buy assets that require asset management to add value. As I say, REI don't own those businesses. I remain chairman of it, but I do get the market intelligence that's available to those businesses and an early insight to any market moves. If we can move on to the next slide, Anna. There you can kind of see the pattern of this business. Various fundraisers. As I say, management are committed to a dividend policy. It would have been easy to halt that last year, but we're not in the business of not rewarding shareholders. We paid a covered dividend, and as a REIT, we have a commitment to pay out a certain amount. In fact, we actually paid out in excess of our minimum requirement. We could have paid out more, but on the basis that we repaid 4 million of debt to one of our banks and reduced our borrowings, and also did a £2 million share buyback, I was comfortable keeping the dividend level at where it's got. And as you can see, we've had a bit of fun over the last year. Just when you thought you couldn't get any worse than the financial crisis, the elections were a mess. Scottish and European referendums were even worse. Brexit, we all know about, and if you couldn't make this up, so they threw in a COVID-19 just to test our business model. And I do genuinely believe we have been tested. We've come through it. We're nicely intact. Yes, we need to get our valuations down. We've continued to pay a dividend, and this is a very steady, solid business. If we can turn over to the next page. So this is our business model. It's what we've been doing for nearly 40 years, previously in a private capacity, now in a public company. So when we say we buy things for between 8 and 20%, quite often investors think, well, they really must be buildings that are falling apart and nobody wants them. Rest assured that every asset we buy is something that a high net worth, a propco, or a fund manager or an institution would want to buy. And mostly we buy them off institutions and fund managers in the first place because they don't like to hold assets that are sub 5 and 3 years in terms of rental income. They don't like to hold assets that have got a bit of void. We buy them because we believe with our market intelligence we can get that void filled, get some income in, pay dividends, and get some valuation growth. So we buy what the left-hand box says. We are not a development business. It's not what we do. I've seen developers come and go over the years. It's not our business model. Through active asset management, rent reviews, lease renewals, small-scale refurbishment we obviously have to do, and some planning revisions, and I'll talk about some planning changes in a little while. We add the value. We then either sell or we hold. We hold and obviously pay out a dividend, or we sell for book value or more and turn our cash over into new opportunities. Turning over to the next page, please, Anna. So you can all see there we've got the Commonwealth Games, but I'm not going to do my bit for the tourist board here. Flick straight on. So these are our operational highlights for the year. You can see that the pattern has all been in a positive direction across the board. Obviously, things have eased off in 2020, purely down to COVID. I don't believe we would have seen this reduction in our performance if it hadn't have been for COVID. And in fact, I think it might not have been as bad if the Q4 lockdown hadn't taken place. So overall, strong rent collection. That obviously provides for a number of tenants that we've got on temporary monthly arrangements or deferred arrangements. You'll all be aware that the government have legislated to allow tenants to withhold rental payments. Well, I'm pleased to say most of our tenants pay or have agreed payment structures with us. The only ones that haven't paid are embarrassingly those that can pay. So the likes of Boots, Wetherspoons, Loungers, Superdrug. Well, I think Superdrug paid about £150,000 off last week. Those are the guys that have really been taking advantage of this and haven't been paying, but they've got very strong balance sheets. I'm confident they will pay, and I'm fairly relaxed about that. Contractual rental income fell off. That's down to voids. And our voids are a little more than we normally have, and that's simply down to the fact that no one is prepared to make decisions on occupying space when in fact the government's telling them to stay at home. So we are already in Q1 starting to see people making decisions about what they're doing next. There's obviously lots of talk about will anyone ever return to an office, etc., which I'm happy to take questions on. The early feedback for the type of stock we own, we don't own big shiny floor plates with thousands of people in buildings. We own out of town offices that are actually already seeing a bit of a pickup because people don't have to travel via public transport. They've got car parking. Lots of calls coming into the agency businesses with people who need more space because they can't manage with social distancing in the space they were on. So that's why contracted income fell off. Gross property assets have declined purely down to the revaluations that we've seen. We've seen some pickup in lettings. We've got some in legals. That figure was at the end of March. It's already gone up, as I've just mentioned. We've just let the Burton's unit as well. We made a number of sales last year, and we deferred completions. This wasn't at the request of buyers who wanted deferred completions. And there's a very strong buyer community out there still. It's really been at our request because we've got a number of oven-ready properties we could sell at quite a strong price. My problem when I sell them is I end up with a lot of cash in the bank and a lot less income. So we try and defer these. So we've, for example, sold the oldie last year and completions not until September this year. That gives us the income from that older unit between exchange and completion, and it gives us time to find an alternative asset so that we've got the income stream coming into the business to continue to pay a covered dividend. I mentioned earlier that we've done a number of lease events. We've used the circumstances to speak to tenants and agree terms. So a lot of activity, which has improved our WALT from 4.8 to 4.84 and 6.5. Occupancy, as I say, we tend to be 90% or plus all the time, but we still are. I'm absolutely convinced if we hadn't have had COVID, a number of other units would now be let. And I'll talk about coming out of COVID, but I can see some delay in office occupiers making decisions still, although that demand is picking up. Oddly enough, retail demand is extremely strong, but we only have convenience and neighbourhood retail. We just don't do city centre, indoor shopping centres, and standalone retail parks. Turning to the next page, please, Anna. Financial highlights. Underlying profits, on track. If it hadn't have been for COVID, that would have been higher. Again, revenues pretty stable. Again, if it hadn't have been for COVID, we'd have been higher. Total dividend for the year, as I've said, was 3p. Again, it was paid throughout the pandemic, and it's a covered dividend. NAV has come off considerably, purely down to revaluation reserve, and that's the same cause of the loan to value moving. One of our big goals this year is obviously to reduce that, but I'll talk about how we're going to do that in a moment. If we can turn to the next page, Anna. So this is the key goal this year. We want to improve income, we want to improve occupancy, get some valuation recovery. I do believe market sentiment has already gone in favour of improving values, and all the auction results in Q1 suggest quite strongly that valuations are much higher than where the valuers have valued them, and this is generally across the board. And we could easily sell a number of properties. My problem at the moment is there is no distress out there for us to buy, and anything I've looked to buy has been at a much bigger number than we might be happy paying. So therefore, we've got to really arrange to buy something before we make many more sales. So we've had a valuation decline of 12%, and that's despite the fact that we don't have any indoor shopping centres. We don't have any Debenhams, House of Fraser, Toys R Us, Arcadia, as I've mentioned. But, you know, we are going to get caught in this retail headwind. But as the weeks are going by and people are returning back to the auctions and investors are coming out, and there are lots of investors out there, high net worth, overseas investors. The only guys that haven't really got back in the game are the UK funds. We're not seeing them, but there's plenty of money around. Auction results are at record levels. You know, the market is strong. Occupancy decisions have obviously been on hold for all the reasons that we can understand, and they have been at the heart of you know, seeing the void that we've got. We broke the valuation declines down on the bottom there. That covers pretty much everything. The few large ones in the top section there. How we're going to get to valuation recovery is obviously what this is all about. End of lockdown, return to work, and occupiers making a decision is going to be key to this. We've already got a number of lettings and legals to the NHS and the Department for Work and Pensions. There's plenty of pent-up demand there from occupiers, particularly neighbourhood retail and town centre retail. And by the way, I think there's a very different picture here in the Midlands to other parts of the UK. I think London and the South East has got a much bigger problem in terms of high street occupancy. We've obviously got real estate giving you the returns that we can compared to the alternatives at the moment. And one of the big game changers really for retail is the planning uses that have been implemented for the high street. So in the past, if you wanted to convert a shop or any store on the high street to a doctor's surgery, a gymnasium, a dentist, an office, a restaurant, you had to go and get planning. Well, you no longer have to do that. So the letting, for example, that we've done in Nottingham was an ex-Sainsbury's, because Sainsbury's have moved nearby. We put that on the market, looking for a retailer, because that's what the consent was. Not getting much interest as it happened. And then suddenly the planning rule changes. We've got the whole thing let to the NHS at a higher rental than actually we anticipated for the retail use. So in addition to that, the upper parts of all of these properties can now be converted to residential, and the very early savvy private investors or small propcos are all over retail to buy them, to convert the uppers into residential and the ground floor to alternative uses or retail. And I think that community are going to do very well over the next few years. I expect valuers to revisit their values across the board because they're seeing stronger comparable evidence, they're seeing stronger occupier demand. So in essence, I see valuation recovery from some return to normalisation probably by over the next 12 months. You know, we've seen some early signs, but they've obviously got to drip into the valuers' mindsets, and investors have got to get out and start doing deals, of which we're already seeing some. Next slide, please, Anna. It's all good and well, me and the team here and other people telling you about their property businesses, but I just thought we'd share with you what the guys who are the experts on our patch are saying, and again, I'll let you read those at your leisure. But the investment agents I'm speaking to at the moment are short on stock. and strong on buyers, and asking me if they can sell a number of the properties they know we own. Well, I could if I could buy something, and I think we'll be selling things for much more. If we were really wanting to cash this business out, and I've got a parade of shops presently valued off 9% or 10%, I could break these up very easily and sell them in the auctions at 6 and 7%. So the break-up value of this business is significantly better than the whole of the value of this business. But the experts' comments are theirs. Turning to the next page, Anna. Again, fairly self-explanatory. The thing I just wanted to pick up, because I've already covered some of this, you know about revenues, you know about underlying profits. The pre-tax loss is obviously down to the revaluation reserve and as a non-cash item. We've got a little bit of a hedge on some of our fixed. That has improved in excess of £500,000 already. You may or may not know, but we also embarked on a share buyback last year, and we bought £2 million worth of shares back at 28p. Quite honestly, when our share price was down there, the best real estate we can buy is actually our own shares. We wouldn't discount that if the share price was to fall back further. Even at these levels, you could argue whether we should be buying more of our shares rather than buying property. But we are a property business. We want to have a dividend and take advantage of some of the opportunities that are out there. Turning to the next slide, which is all about our dividend. As I say, we are fully aligned to all our investors, very keen to continue paying a covered dividend. We've been growing and growing and growing that year on year. This year, for reasons I've explained, we've had a lower dividend paid out. The board's view that was the sensible thing to do. We used some of the cash we could have paid out to buy some shares back. And we also paid £4 million of our overall debt down as well. So we used some of the surplus cash to improve the balance sheet. Next page, rent collection. It's suddenly become the thing. I have to say, in my mind, it's only ever been the thing. With no rent collection, you've got no revenue. With no revenue, no rents, you've got no valuation. So it's always been about rent collection, and I'm pleased to say we've done very well. Government legislation has not been helpful. No landlord's going to be particularly complimentary about how the government have been disruptive to the business, but we've all come through it, or those of us that are able to have come through this. Rent collection was good. We've spoken to people. I think each quarter will get better as the period goes longer, and also the moratorium legislation imposed by the government comes to an end at the end of June. The mood music is that they are actually going to end it now because they've renewed this on a couple of occasions. And we're hoping the likes of Boots, Waterstones, Loungers will actually pay, so that will be quite a nice improvement in our cash. Next slide, please, Anna. Page 13 on my sheets. I talked about the diversity of our portfolio. It's pretty well laid out there. Our largest tenant will always be below 5%, other than the government. And even the government is in lots of mixed pots, from the sort of the NHS income through to sort of job centres. That income has stayed pretty steady, and obviously we like retail. If I could invest money today to get a good return, both as a yield and capital growth, it's the retail space that I would be looking into. But we're just not seeing value. Everything I'm looking at, there's somebody prepared to pay 10, 15, 20% more than we're prepared to pay. And you've just got to look at the auction rooms and the prices things are going through there. They are, extremely strong. But when we have retail, I just want to stress to everybody, we do not own a Debenhams. We do not own a House of Fraser. We do not own Toys R Us and all of those challenges. Convenience and neighbourhood retail is very strong. Through our agency business, the biggest occupier demand remains on a sort of convenience and neighbourhood retail. Next page, I mentioned earlier on a little example of what I think is going to finally be a bit of a game changer for the high street, and that is the planning use. That one there is the example where we had Sainsbury's on the ground floor who left for a larger build nearby. Upper parts is residential already on this, but we've managed to get the NHS. We are hoping to sign that lease this week, and we've got a bit more rent than actually I thought we would. And I do see a move from occupiers that traditionally were in alternative arrangement. I can see them going to the high street because that's where the customers are, that's where the car parking is, they're getting sensible rents. So doctors, surgeries, dentists, office, wealth managers, they'll be more available on the high street than they have been in the past. And a lot of them are keen to be owner-occupiers as well. Next slide, please. Just some examples of asset management. I stress that we are not a passive holder of assets. We aggressively work assets. 34 lease events last year, and we've done plenty already this year, and I'm hoping to do many more going forward because occupiers are in a state of change. They're talking to us about either downsizing or upsizing, and clearly we'll do things that are in our commercial best interest. As I said earlier, I've got plenty of buildings I can sell to high net worth, the small propcos, the small funds, lots of overseas buyers, lots of American private equity knocking around. But if I sell 20 or 30 million pounds worth of property and the related income of it goes with it, that hits our revenue very quickly, and we don't want to live off capital. So we will probably look to buy a few things before we sell a few things, or we'll wait for that revenue to come in and know that we can replace the revenue through acquisitions. Next slide. If ever you wanted a boost to your economy and you said, well, what can we have? Those of you that are London and South East based will remember what the Olympics did. We're hoping that the Commonwealth Games will do something similar for us in the short term. That is definitely going ahead, as I understand, and our present chairman is chairing that. So the inside, noise is all looking very good. Coventry is the City of Culture, I think, from May the 20th. Again, a bit more vibrancy. Even the shops opening this week has significantly improved what's going on here. I think people will return to the city centres in the regions quicker than they will in London, and we're already seeing some evidence of that, but our exposure is not in the city centre space as such in any case. I did mention in passing that Goldman Sachs have announced this week that they will be coming to Birmingham. Very nice. Obviously shows you what people are starting to view. As a sort of a very personal thought, the London and the South East has had a phenomenal 50, 60 years. I think going forward, the UK regions are really going to be the pick for the next 50 odd years. Finally, we've got a very loyal and committed team, all experienced here in the Midlands, and dedicated to everything, and they've done an outstanding job during COVID. And finally, why REI? Well, I think we've demonstrated that we can live through tough times. What will we do this year? Well, it's a year of stability. We just want to get our income a bit more balanced, get some of our occupancy back up again, continue to maintain our dividend, and as I say, maybe have the same pattern that we had last year and look to enhance that final dividend. The opportunities within the portfolio are enormous. Number of little windfalls that we're talking to people about, reletting expiries that have taken place, and we have had some expiries, but that's normal for us. Change of use is going to add a little bit of an oomph to the retail sector. Gaining some valuation will reduce our gearing, and we'll sell a couple of properties for better than book values, more likely our 19 values. And there is a strong investor market. I really can't underestimate that enough, because everything I'm looking at to buy, I'm being outbid on. and there's more new money coming into the market all the time. We'd like to make acquisitions, but as I say, they've got to be on the right terms. We're not in the business of paying 4%, 5%, 6% for assets and just sitting on them for a while and watching their valuation go down because their leases are expiring. I think I put market consolidation at the bottom here. I said this about a year ago, and we have seen a number of REITs absorbed by larger vehicles. If COVID hadn't have come along, I'm not so sure that the number of REITs in the UK that are out there would still be there. I can see some consolidation in the sector, and I think there will be more deals done going forward. A number of the REITs will probably want to get their balance sheet back and their revaluations recovered before they're open to talking to anybody. A number of the REITs were very specialist, and I think they might be coming together so that you've got diversity under one umbrella. As for REI, we are very happy to enter into any discussions. If it's in the best interest of the shareholders to sell the business, we would sell the business. If it's in the best interest of the shareholders to go out and do a placing, raise more funds and grow the business because the opportunities there, will do that. As I said at the beginning, we are fully invested, fully committed, well experienced, with strong market intelligence coming into the business, and that has allowed us to get through all the challenges we've had over the last few years. And this year is not going to be an easy year. There is going to be some time for things to get back to some normal. But rest assured, we're very comfortable with the business and the team managing it. So on that basis, that's kind of about me, I think.
Paul, thank you very much indeed for a very in-depth presentation there. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while Paul takes a few moments to review those investor questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation is ended, you will be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Paul, perhaps before we step into some of the live questions, we had a number of pre-submitted questions from investors, and if we could perhaps start the Q&A session with those, I'll just read them out, that would be great. Mm-hmm. The first question we've got here is: the portfolio is often referred to as diversified, yet being geographically based in a region which is a distribution hub at the confluence of 3 motorways, and in addition, home to thousands of industries, there's a complete absence of industrial warehousing and logistics property in the portfolio. Why has there been a policy to avoid buying assets in this class, especially if the current investment market is very robust?
Yeah, very, very, very good question. We are in the heart of industrial units, warehouse, distribution. When we set the business up, there was a company called Mucklow who are no longer in existence. They're now part of Metric. They were the industrial specialists, and the industrial market really didn't show us any value. And I believe, as we sit here and speak, it is grossly overvalued. There are some things that are fairly valued, but I think 2/3 to 80% of the industrial market, distribution warehouse market, is overvalued. So the reason why we haven't gone into that space is somebody else was strongly in it. We didn't see any value in it. We saw value in shops and offices. All the market intelligence that we were getting in terms of inquiries was demonstrating that. So, we bought things that were 50, 60% empty, and we've gone up to 90%. So, we specialise really in sort of convenience and neighbourhood retail and non-city centre offices in the main. And we stick to our knitting, we stick to what we understand. But right now, I wouldn't be going into that market because there's just no value in it for us.
That's great. Thank you very much, Paul. Next question we've got here is: can you give us a bit more of a feeling of what is happening on the ground now that we're starting to end the lockdown restrictions?
Sorry, I just lost you at the beginning of that, Paul. Could you say that again?
Absolutely. Can you give us a bit more of a feeling for what is happening on the ground now that we are starting the lifting of lockdown restrictions?
Right. Well, I think most of this is covered in the daily news. The world is slowly going back to work. Here in Birmingham, it's significantly busier since the shops have opened. More specifically about the property market, it's kind of in business as usual in the residential sector. Investors have been hunting and looking to buy things. It's occupancy that's really been slow, i.e., people are not making decisions to occupy property when they know they couldn't return. So, what's it like at ground floor level? I think from a buying and selling perspective, very busy. From an occupier market, people are sitting on their hands, but that looks like it's set to improve. But please don't think that everybody is downsizing. A lot of people are having to upsize because they just can't manage their staff in the way they used to. Mood music is that people want to go back to their offices, but I don't think they're going to be at their offices 5 days a week as they used to. I can see flexi hours being more important, and people may be doing 4 days a week, 3 days a week. And trying to avoid public transport, which is why I think the calls coming in for non-city centre offices are stronger. Retail, it's just doing really well. I mean, neighbourhood retail is doing really well. Those that couldn't open, obviously, are looking forward to opening, but all of those look in pretty good shape. I'm confident they're all going to have a pretty good few months going forward.
That's great. Thank you, Paul. And the next question, I think you've covered off in part in the presentation, just a little there. Do you think more flexi working practices will increase the flow of people out of London and into the Midlands?
Yeah, I think there's been a trend over the last 5-10 years of people leaving London and moving to the Midlands. I mean, notwithstanding HS2, schooling, generally education, facilities, airport, trains, job opportunities, restaurants, all of this stuff has significantly improved in Birmingham. And there's been quite a strong move to the Midlands already. I think the Commonwealth Games will highlight Birmingham and give us sort of a global showcase to show people that we're not full of industrial sheds and pre-war houses. It's a very vibrant, prosperous community. It's got its challenges like everywhere else, but I can see more and more people coming out of London selling their 2-bedroom flat for £2,000 a square foot and buying, and that's at the cheap end, and buying a house outside Birmingham for £400 a square foot with 2 acres of ground. That is that's a consistent pattern, so I don't see that changing.
Thanks, Paul. Short one here. In terms of office space, how has the demand changed? And I think, again, you've covered some of these points, but if there's anything further to add, that would be great.
Yeah, I mean, things are changing. I mean, I'm not burying my head in the sand at all. I'm right in the face of seeing the change. I think if I was doing a 250,000 square foot commercial development in the city centre looking for office occupiers, I probably would be feeling a bit uncomfortable. Generally, people will, I think, change their office space. Some people will need a bit more. Some people will want less. People are going to be using it less during the week. The biggest change for office occupiers, I think, will be the travel during the day. With the discovery of Zoom and Teams and all of these things, people won't necessarily need to go and travel to see people. They'll quickly do Zoom meetings, etc. But I strongly believe, and this might be old-fashioned, but businesses that don't go back to work will be left behind the businesses that do go back to work. I'm trying to run our business. It's a fairly small team. I can't wait to get everybody back so I can link everybody up together here and get people working, because working away from the office, people are reactive. When they're in the office, we are proactive. We're talking about occupiers and ideas and opportunities. So, we're in a changing world, but it's not necessarily for the worse.
Great, thanks, Paul. A couple more to go through. On M&A, who are the buyers and sellers for Midlands property?
I think I've touched on this earlier. American private equity, lots of propcos, lots of high net worth individuals, lots of overseas money that I've never ever heard of before, French money, a lot of Israeli money around. There's just generally, I've never seen it like this, but I guess if you look at what the world banks and the governments are printing everywhere, it's going to filter down. There is just so much money around. And yes, it likes to pick off the really clean, beautiful stuff, but that's down to 4.5%, 5.5%, 6%. And then people, and every cycle it's been the same, people have to start looking up the risk curve. And actually there's less risk in that 7 or 8% multi-occupied space where there's more occupiers and you're not reliant upon one occupier. So there's a multitude of investors out there. There aren't very many sellers. There's plenty of buyers, there just aren't very many sellers. Part of our agency business has got an auction side to it, and that auction side does about 150 million in sales a year. I haven't seen a distressed asset or anyone mention a repossession at all. There just aren't any. The banks are behaving in a very different way, whether this is through their experience or three-line whip coming out of central government. They're managing circumstances, they're giving people space. So there's no sellers and lots of buyers. And there's only one thing that will happen in the fullness of time if you've got too many buyers and not very many sellers.
Great, thanks, Paul. Next one's around banking facilities. You have a renewed banking facility of 51 million for 3 years to March 2024. Does this build up risk in terms of being a variable and over a short period of 3 years? Is longer fixed term borrowing too expensive or not offered?
So you'll see from the presentation that up until this year we were significantly fixed. I think it was 80-something% without flicking the pages back again. And it's about half that. So this facility was only put together a matter of a few weeks ago. And we've taken it on a variable basis. We've received over the last week, 10 days, daily fixed arrangements that we can fix this on. What we're probably going to do of that 51 million is fix about 35 of it. And the reason we're doing that element is that level I think will stay pretty sticky because we're making some sales of properties. We don't want to have penalties and costs being incurred when we're paying down debt. So we are looking to fix that, and we'll probably do that over the next few weeks.
Brilliant, thank you. Penultimate one here, we've got EPRA EPS equals 4.5p. What would that would imply a distribution of 4.05 pence instead of 3. What are the reasons for this?
Yeah, I said earlier we could have paid more, but our obligation was to pay a minimum of 2.75 under the REIT rules. As you know, we paid out 3p. We've kept some cash back because our gearing is not where I'd like it in a public company world. We've bought back £2 million worth of shares, and we paid off £4 million of debt through cash. So a sensible approach was to pay the 3p this year, but as you can see, we could have paid more, but we've not just sat on that money. We've bought back shares and paid off debt.
That's great, Paul. Thank you. And the final pre-submitted question we have is around the impairment of financial assets. Does this mean that losses are recognised earlier?
Yeah, this is due to revised accounting standards issued by ICAEW. In reality, there's no change in how this would affect our accounts at all.
That's great. Paul, that concludes the pre-submitted questions. Perhaps if I could ask you just to click on that Q&A tab, you'll see we've had a number of questions submitted during the presentation today. If I can just direct you there, and if you could read out the question where appropriate to do so, that would be fantastic, and give your answer. Thank you.
Okay. Peter J is the first one I'm looking at. If you can't buy new units, will you prioritise share buybacks or dividends? Will you consider buying other local companies or REITs? Absolutely everything's always an option. We don't, have a fixed approach to life. I do think we will find new units. We are very well networked, not only through the market intelligence of our related business, which, as I stress, is not owned by REI. I just have access to the market intelligence. but I've a great relationship with everybody at every agency business here in Birmingham. I've worked with them all for 40 years. They have strong relationships with our other staff. So I'm sure we will buy things, but I've got to sell and buy, or rather buy and sell. Would we look at other REITs as part of this question? And the answer is yes. Let's just say that we are already looking at other REITs, because if there's an opportunity for us to buy another REIT that might be smaller than us, or merge with another one that's about the same size, if it's in the best interest of the shareholders, we will do it. Please rest assured, we're not a management team here that are worried about our jobs or anything. We will do absolutely the right thing by the shareholders, because we are a decent sized shareholder ourselves. So do I just keep reading these questions? Yeah.
Yeah, please absolutely, Paul. The ones you're happy to answer, that'd be fantastic.
Yeah, okay.
Thank you.
Interesting one at the bottom here. Andrew M. Is the business over-reliant on the experience and leadership of CEO Paul Bassey? No. I mean, yes, I have a role to play on the face of the business. I totally get that. I've got an FD who knows this business inside out. But the team of people I referred to that are in that slide there, if I was to come under number 11 bus, they have the same relationships, they have the same integrity, the culture to how we run this business is what we drill through. And at some point, I might not be here. I'm 60 years old next year. I'm a fit and healthy 60-year-old, but the show will go on here, whether it's me or the other team members running it. Sort of a related question, James D. I'm a very happy existing holder, wondering whether to recommend RLE to my children for long-term investment. Will you do this till you drop? Do you have any succession planning yet? Well, I'm not going to recommend to anybody what shares they should buy. All I can tell you is I have 12 million of them. Will I do this till I drop? Well, I've got no plans to drop just yet. Succession planning sits here every day of the week. If I were to come under number 11 bus here, the show goes on. The rents get collected, the lease renewals, the rent reviews carry on. The market reputation is strong. The network is strong. At some point, we will look for a new chief exec if we still are in the form we're in. More likely, I think, that we will acquire or be acquired, or maybe even go out and do a fundraise and grow it significantly, at which point we will bring more of a team in. Nigel B. Do you own or have you considered buying property outside of the Midlands to diversify the business? In a nutshell, no. Our market intelligence and our network drives what we buy and how we manage the business. I don't have phone calls, boards, sold, let, inquiries, viewings taking place in other parts of the country. So I don't know what the mood music's like. I don't know what investor demand's like. I don't know what occupiers demand. So why would I go and invest in an area where I don't have that advantage? That advantage is ours here, and we play to that. Question from Vaughan. Any view on future quarterly dividends? The view is that we will continue to pay quarterly dividends. The board will confirm what the first quarterly dividend will be. The likelihood is that we will follow a pattern similar to last year of a quarterly dividend at a level to be confirmed, and a larger dividend at the end. And again, we've been doing this for a long time. We're not an unpredictable business. Even through COVID, we were fairly predictable. You've got to have a little bit of luck, but a lot of hard work's gone on through the team. So dividends are what we are. We're a REIT. We've got an obligation to pay out a certain amount, and in all likelihood, we will be similar to last year. Simon C. Good presentation, plenty of money around, as you mentioned. How competitive when bidding on new assets, or do you source most opportunities off market? Yeah, we don't get in bidding wars with anybody, even if there's a deadline. I can assure you that I won't meet it. We've got good enough relationships with the advisors to ring them up. I believe we're a preferred buyer in most cases. We know what we're doing. We're always a cash buyer. So we don't get involved in bidding wars. If it's not on our terms, we won't buy. Yes, we do secure a lot of things off market through professional advisors, but at the moment, even that's pretty thin because there's not much stock around and a lot of buyers. Nicholas L, a couple of questions here. What's anticipated contractual rental income for 2021? Very difficult to answer because we've got some void that in a normal world I would expect us to fill. But occupiers are taking their time making decisions. So if we're around where we are now, 10% either side of it, 5% either side of it, that's kind of where I think we'll be. So that's that. Is there an opportunity for the company to expand its portfolio to take advantage of the fall in property values as a result of COVID-19? Well, there's a limit to our capital. If I could see that opportunity, we've spoken to our brokers and others, we would go out and raise some funds, but we're probably going to need to move our share price significantly higher before we go out and raise any new funds to take advantage of those opportunities. And you'll have seen from our timeline, when we saw market opportunity, we went out and raised some capital and executed. So if that opportunity arises, we will do it. So that was that question.
I think, Paul, actually, you've literally gone through all of the questions that you have, and we've just gone through the hour. So look, thank you very much for being so generous with your time and answering every question, and also for a very in-depth presentation there. Before we just redirect investors to give you some feedback, Paul, perhaps I could just ask you just for a final few words to wrap up, please, if possible.
Look, we're a very simple business. We are well invested as a management team. We've got 100 years worth of experience amongst us. I've been doing this for nearly 40 years. We have got the unique advantage of having access to market intelligence that most property companies don't have. We're keen to do the right thing by the shareholders. We've demonstrated that by not cancelling dividends, because that would have made management's life a lot easier because you have a lot more cash in the bank. We've paid down debt. We've done a share buyback. We will keep doing the right thing. There will be challenges out there. There'll be voids out there, but there'll be windfalls out there. There's a couple of windfalls that come to mind very quickly. I think we'll have another steady year, and I anticipate some valuation recovery. Will it come as quick as the half year? Not so sure, because valuers tend to lag the market. Do I think over the next 12, 15 months we will see valuation recovery? Absolutely. Do I see there be market consolidation? Absolutely. Do I think some of the smaller business, and that would include us, and do I think we are likely targets for others? A nice £200 million plus portfolio, well managed with lots of upside with it, kicking out cash. I can see people liking that. But in the meantime, we will keep running this business just as we've done for the last sort of decade plus. I'm going nowhere. I'm in good health. My team is great. They've really proven themselves over the last 12 months. It's going to be a very tough 12 months going forward, but we'll meet the challenges that come our way.
Paul, thank you very much indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback page will appear in front of you, but if you've accessed the meeting via the link in the email, you'll simply be asked just to log back in, and it'll take just a couple of seconds and is greatly appreciated by Paul and the team. On behalf of Real Estate Investors PLC, we'd like to thank you for attending today's session. That now concludes today's event. Many thanks indeed.